all over. Hello, my name is Darwin German, and I'm presenting to you the Citadel at Preston, the next acquisition for Darwin German Real Estate Investments, and probably the final one for the year 2021. We've had a great couple of years, even during the pandemic. We've grown and purchased many properties, sold a few of them, and had an absolutely great year, even with all of the restrictions. But I want to present the Citadel at Preston. You can see a picture of it up here. And the location is right here at 635 and Preston Road. Okay, zooming in, it's right at Dallas North Tollway and Preston Road. This is the location here. Just to the west is I'll zoom in more, North Dallas Bank and Trust. This is about a 12-story office building. Directly to the east is medical. And all the homes to the south, these homes are anywhere from $500,000 to over $2 million in this whole neighborhood just south of us. So this is an absolutely great area. Preston Road, highly traveled, great road. And directly catty corner, you go directly from the Citadel right there. And I'm going to zoom out just a little bit. And this whole area here, it was the Valley View Mall. Now, that was a dead mall because this location here is the Galleria Mall. High-end, very nice mall, very upscale. And Valley View just has died over the years. And they've been working on a project for the last, 10 years or so. And let me show you what this project is. Now, again, the location, catty corner, here is the Citadel. And here is Valley View Mall that's going to be Dallas Midtown. This is what's going in right here. Okay, this is Preston Road right here on the right-hand side. And that's that is Montford Road right there. Preston Road right on the other side. So this is the big development that they're trying to put in right there. Now, just to let you know, they've already been demolishing everything there. They're already cutting in the ground. Like I said, this has been in progress for about 10 years. This is a $4 billion development, $4 billion. Very high-end luxury area that they're converting all that area to. Okay, you can see here, there's an East Park and a West Park. Now, this is a longer term plan because the land right between Preston Road and the Galleria already has 2 or 3 apartment properties, 2 or 3 office buildings, a Target, and all sorts of things on that west side. But the east side, they're already moving ahead on. As a matter of fact, I anticipate an announcement next week for the big first tenant to go in there that's supposed to be going in next year. And it is a Fortune 500 company, another one out of California, to relocate to this location. So this is one of the reasons why we like the area, is this $4 billion development that is now going in. We also, Dallas Midtown project go vertical by early 2022. This was an article in the Dallas Business Journal explaining that this is getting started and they're cutting in right now. And this was an article in the Dallas Business Journal. Going back to the map, we can see the location is great. We'll zoom in just so that you can see the rest of it from this point of view. You can see it's funny, it almost looks like jigsaw puzzle pieces, but this is the property right here with the 12-story building next door and medical just to the east, and 500,000 plus homes just to the south. So all of that is very, very exciting just on that part. And when they get this thing built in here and our property's right across the street, that makes it even more in demand, being in such a high growth area where they're putting all this in near downtown. Okay. I'm going to switch over now to Excel and go through, this is our investment presentation. The investment presentation outline, it's kind of our business plan for what we're going to do with the property and how all of the numbers shake out. This is the Citadel Apartments, one of the pictures, And before I do that, I'm actually going to do one more thing. Here is the offering memorandum, also called an OM, for the Citadel apartments from the broker. It is in great shape. We'll show you some pictures here. So you can see that they have Preston Road, North Dallas Bank and Trust, and this is the property here, right next to their parking garage and their 12-story building, right by the Galleria. And the property located freeway frontage on LBJ on 635, which is very good access, and the whole development, Dallas Midtown, right across Preston Road and across the freeway. Of course, this is what the broker puts together as far as how you can increase the value. Of course, he's putting in a 5.69 potential value creation at a 5 cap rate, which cap rates are obviously much lower right now. So we're going to do a lot of these. Upgrading the classics to platinum, that should add $174,000 in income or $3.5 million in value. The water conservation program, which we've got a bid from Save on Water, and so it costs $63,000 for that, but it'll save $46,000 a year, which is $930,000 in valuation. Furnished washer and dryers. Now, I don't know that we're going to do that. I haven't been a big fan of that, but it can add $444,000 in value. Upgrade the partials to platinum, adds another $17,000 or $344,000 in value. Reserved uncovered parking. So they're barely charging anything, so we can raise the price on that and actually lease out reserved uncovered and increase the covered parking fees on both of those to add value on both of those. We can add fenced yards, and then of course the trash fee service, along with all of the other things. We've got a technology package that we put in that we make a lot of extra other income from, and provides great broadband internet service to our residents, along with TV, and at a drastically reduced price than if they were to go out and get them themselves. So we pretty much make that mandatory on properties because it is a profit center and it is providing something great for the residents. And again, there's the same thing. They're all 2 and 3 bedroom units. They're all bigger units. They've already got a lot of CapEx that they put into it, and it's in very good shape. And again, just mainly look at the pictures here because this is just explaining the updates and upgrades you can do to raise the rents. What's funny is this property looks a lot like another one we had, Tribeca, and as far as its style and layout. Here's some more pictures of the property. And again, they already did a lot of the heavy lifting as far as exterior CapEx, and they've kept it in really good shape. Standard Formica countertops, black appliances, so that's pretty standard as far as a standard unit. More pictures. You can get a good idea again. This is looking west. Here's the property. Here's the bank building, here's Preston Road, and then catty corner right there is where that $4 billion development is going in. More pictures from the roof, of the roofs. Floor plans, 2 and 3 bedroom units, all good size units, anywhere from 1,028 square feet to 1,300 square feet, so these are big units. Location, built in 1969. Individual HVAC, individually metered, and of course we bill back for gas, water, sewer, hot water, etc. Tax information. And this is another look at the planned development, that $4 billion plan that they have. So I want to get into the numbers, which is the important part of the business plan. Okay, here's a nice pretty picture of the Citadel. And of course, that's one of our projects that we're doing. So we're the sponsor, Darwin German Real Estate. We are paying $14,550,000 to it. Now that's $181,000 a door for 1969 property, which seems a little high, but the location is irreplaceable. The location has huge amounts of value to it. And having apartments right next to $500,000 to $2 million homes on the freeway with easy access all over town right there on 635. Closing costs will be $727. We're looking at putting $600,000 in capital improvements in there at $7,500 a unit to upgrade the rest of the units need to be done and doing the extra work, water savings, etc. We're going to put $150,000 into our operating account so that we have cushion for our operating account just in case there's anything comes up. I put in $22,500 for miscellaneous. And really that is just because there's always a little cost here or there that we have to absorb. And the number, why it's an odd number, is really because then we can have a nice easy capital raise number of $5,050,000. We've got an $11 million loan. That will end up being a bank loan bridge debt. We're looking at a 5-year note, 3 years of interest only with extensions. The sponsorship, DGRE, is getting 15%, guarantor 5%. Of course, we do have our acquisition fee of 3% in there. We're getting an $11 million loan. We're estimating 3.75%. 5-year loan, payment $616, and interest only at $412. And again, I think we're going to have 3 years interest only, and that's what's budgeted in here. And a refinance in year 3, which is a cash out refinance. So there is a cash out proposition to this property. Great location, great returns, and a cash out refi. And we're averaging a 15.3 5-year average investor ROI, which we think is pretty conservative, and we'll show you why. Now this down here, Fannie Mae refi, that's what we're looking at refinancing into in 3 years. Current rent schedule, you can see all of it's mainly 2-bedroom units. There's 63 of the 2-bedroom units, and then another 17 3-bedroom units, ranging in size. The current rents are $1,142, which is only $1.05 a foot, generating $91,000 a month at full occupancy and full collections. We believe we can raise the rents to $1,300 plus. We think we might be able to do a little bit better, but we want to be conservative on that. Again, 80 units built in 1969, 3.7 acres on LBJ Freeway in Midtown. So the land value is actually higher there than most of the other properties we bought. Pitched roof, individual HVAC, individual electric. We've got a boiler for hot water. It's in great condition, B condition. I would say it's a C property just because of the age. In a B condition, in an A location. 2 stories, brick and siding, and it's pier and beam foundation. Now we're looking at putting $400,000 as interior updates so that we can achieve these rents. $40,000 for water savings, and exterior $100,000, and that leaves us an extra $60,000 in cushion if there's anything else we want to do. Again, this is our investment presentation, and that is in our private placement memorandum at the very back. And the offering memorandum that I showed you earlier is also in there. So when you get your PPM, you can review all of those. But in essence, this is our business plan to show you what we're going to do. Okay, the next area that I do is I take the current numbers from the owner of how they're operating now. Current scheduled income, that 91,000 times 12 is 1,096. Their vacancy and collection loss that they're saying right now is 3.4. Now, if their vacancy and collection loss is actually 3.4, then we know the rents are already too low and we could raise rents organically anyway. Net rental income, after that vacancy, other income, total operating income, minus all their expenses gives us a cash flow. Net operating income is $621,000. Now, I go in here and I put in minimum assumptions. What do I do what's happening if I really screw up, and what's happening if I really do good? And then I do something somewhere in the middle that is our actual pro forma. So we take the raised rents, $104,000 down here, times 12 gives us $1,248,000. We plug in an 8% vacancy, in collection loss combined, which is obviously much greater than their 3.4. So our rental income, $1,148,000. So raising the income that first year about $80,000, $90,000. Other income, this is an area they're really missing out on. So with the tech package and all the other stuff, we think we can raise that other income to $260,000. So total operating income, $1,004,000. Property management fees at 3%. Payroll, we're estimating at $100,000. It's only 80 units, so we're talking about 2 employees there. Contract services at 37. General and admin, and you can glance over here and see what they're currently paying, which is usually pretty close. Because we're local and we operate better, I think we can do like I said, that payroll at $100,000. Maintenance and make ready at $75,000. Now it's a little lower than what they're paying right now, but that's because we also budgeted to put in $600,000 into the property. Marketing, $6,000. We don't need as much marketing as they had. Utilities of $68,000. Now this is a big drop, and the reason for that is Save on Water is saying that their study is showing that we can save over $40,000 in water expense. So we plugged in that as a savings. Insurance at $56,000 and property taxes at $250,000. Now, property taxes, this is a big item to discuss. And the reason for that, their current property taxes are $135,000. These are individually deeded condominiums. And so because of that, they are taxed like condominiums, like single family houses. So there's 2 different areas of Dallas Central Appraisal District that do valuations. There's the residential division and the commercial division. The commercial division is very, very aggressive on raising the values, which also raises the taxes. However, the residential division is a little more lax. And just to give you an idea, we just got our tax bills for 2 of our other properties that are condominium properties, and our tax value did not go up this year on those 2 properties. So even though I budgeted nearly doubling the taxes, there's the possibility that those will barely go up. And just for grins, let's do this. Okay, I told you that the 15.3 was our 5-year average annual return. Just for grins, let's take this down to $175,000, which will take the expenses from $8,000 per unit down to $7,123. But if those property taxes right there don't go up like we're budgeting, because that's the big one we have to take into account, now we're at a 20% plus return. Okay, so but we've got a plan on higher taxes, so we'll leave that at $250,000 for now. Net operating income $763,000, company expenses $31,000. Now reserves, here's another big change that we added. Normally reserves are $250 per unit or so, maybe $300, but we plugged in $400 because that's actually a more realistic number for reserves at $400 per unit. Our debt service at $412 gives us cash flow of $287. Now that's a debt coverage ratio of 1.85. Cap rate of 5.2 on projection. Current cap rate on current 4.3. For those of you who like to compare cap rates, 4.3 is our going in cap rate. And cash on cash year 1 is 5.7 for at the property level. Okay? That's important at the property level. That's before it's separated out into what partners get. So our 5-year pro forma. We're projecting in that area 3.5% rent growth. Not year 1 because we've already raised the rents, but 3.5% every year thereafter. Same thing with expenses. Actually, we lowered the expenses from $657 to $644 because of our savings on water and payroll primarily, and a little bit of savings in other areas. But we don't have an expense increase, then we bump that up every year thereafter, and a collection loss of 2% across the board. Now, their vacancy and collection loss, if you recall, is 3.4. We plugged in 8%. Okay, so we're a little bit higher. We have vacancy loss at 6%. Our 2% collection loss gives us net rental income. And just so that I'll just do this so you can see, These numbers match up with our sponsor pro forma here on the left, and it goes out 5 years. Same thing with expenses. 3% on expenses. I'm sorry, 3% on property management, going on down, and to our total operating expenses. So all those numbers are the same, 644, 851. Net operating income, 763. Now, same thing, company expenses and reserves. Now, I plugged in an additional $120,000 in cushion in year 1 and $60,000 in year 2. And I did that because there's always something that comes up that might skew it a little bit, whether we need extra CapEx or we're not hitting our income numbers because we're doing such a big increase right off year 1, whatever else. But this is an additional cushion that I'm plugging in. $60,000 in year 2 also is additional cushion. This is giving us, we're going in at we're assuming a 4% cap rate right now, and then we bump it up 10.1% each year, giving us 4.1, 4.2 in year 3, a 4.3 cap rate. Gives us our value of $19,540,000. Now we plugged in a 63.5% refi. Now that could be a 70% refi, but again, we're being more conservative because we don't know where interest rates are going to be, et cetera. So we did it at 63.5. Pay off the existing loan. Our cost for refi gives us $1.2 million in proceeds from our refi, for a cash out refi. Now we go out 5 years and where the income is going to be and our cash flow. You can see 5% on the property level cash flow, then 7.2, 7.5, and 8.3. And then a value, again, year 1 at a 4%, then 4.1, 4.2, 4.3, 4.4 in year 4, 4.5 in year 5. Just so that we can have some extra cushion to make sure that we can take into account if interest rates or cap rates go back up. 2% cost of sales cost, pay off our existing loan. Again, it was interest only, so there's the 12 and there's the 12. So we have $7,614,000 in proceeds. Now we get to the point of what's in it for me, really? That's all fine and dandy, and I'm glad you got cushion and I can understand all the numbers, but what is in it for me? Now I do 2 different things. I'm going to show you this over here. First off, a sample investor of $100,000 will have 1.58% ownership, okay? So this is the property level. Those are the same numbers from the bottom of this sheet as far as the cash flow. Just as an example, $416,000 in cash flow, $416 up there, and our proceeds $7,614 and $7,614. So that just gets carried right up there. But now, what does a $100,000 partner get? Okay, this is what they can estimate. Year 1 cash flow, 2.7. And again, it's lower because of that extra $120,000 that I took out. So you can anticipate a 2.7 year 1, 4.2 year 3, with the cash out refi, 25% in year 3, 6% in year 4, and that's 6% of the original $100,000. After you've got $20,000 back, in essence, that's closer to 8%. And then year 5, we have cash flow sales proceeds for the total amount. So that's a total of $176,000 to a $100,000 partner. That's a 15.3% average annual return. Now, something we didn't even throw out here was we're also going to do cost segregation and bonus depreciation. That's what we're planning on, assuming no changes in the tax code. And if so, then we're estimating about a 60-65% year 1 tax benefit. So a $100,000 partner, somebody that's invests $100,000, can probably get, I'm going to say, as much as, it could be $30,000, $40,000, $50,000, $60,000, anywhere in there, tax benefit year 1 to offset against other passive gains. And so, but overall, a 15.3% average annual return per year, which is very strong in this market. And you see all the cushion that I put in there. Now let's go out here and I want to show you this. This is something I always do. So this is our uses here. So purchase price, $14,550,000, $181,000 a door. $9,000 in closing costs, $7,500 per door in improvements, $1,800 in operating budget, $281 in miscellaneous. Our loan, $137,000 per unit. Total cash investment, $63,000 per unit. So we're all in at $200,000 per door. Now, I'm estimating the value in 5 years at $255,000. Here's the thing. I have missed that number on every single projection by, let me put it this way, I'm always low on that number. And this is just how the numbers go through. But what happens in 5 years, nobody really knows. But I know that there are properties trading for $255,000 a door. Again, probably not this age, but in that location, and actually not too far from there, there was another property that just sold for $450,000 a unit. And it's a newer property in a better area, but $450,000 a unit for a new property, and we're only budgeting $255,000 sales price in 5 years. So overall, this is our presentation, and it's for information summary purposes. And make sure to consult your CPA and the private placement memorandum so you understand everything about how to invest. But with us selling a few properties like we did this year, there's a lot of pent-up demand for another deal. Now, we're very careful about what we buy, and only raising $5 million, I anticipate this will be done in about 10 days. We'll be fully subscribed in about 10 days. So definitely get your subscription in early. Talk to Julian, Garrett, Jeremy, and get your PPM in. Request the PPM, fill out your subscription documents as soon as possible, because this is only a $5 million capital raise, and like I said, that'll fill up in less than 10 days. Because this is a great property with good returns, cash out refi. It has everything going for it. So let's go ahead and get this deal, and I look forward to partnering with you and bringing you another fantastic deal through Darwin German Real Estate Investments. Thank you so much. Again, reach out to your investor relations person, and let's get you involved. Thank you so much. Have a great day.